Hello, everyone, and welcome to a new podcast episode of Florin Carare, the business matchmaking guru, financial education for teenagers, a podcast series that is happening on every Thursday at 7 p.m. UK time. Welcome, and hopefully you will find a lot of information here that is helpful for you. Thank you very much for watching this. Soon I'm waiting also for other people to join me because it's an educational webinar. Hello, Wojtek, welcome. Let me see, I do not hear you yet.
Hello, can you hear me?
Yeah, yes, I can hear you now, loud and clear.
Nice.
And we are already
Wonderful.
live. Welcome, we are already live on YouTube.
Hello, everyone.
And just a second to give you, I already make you a co-host, so I'll also give you access. So you may record if you want.
Amazing. Okay, yeah, here we are. Just here, okay. Record. Let's go. Hello, Florin, how are you today? I'm very excited for this. This is a new topic for me as well.
Well, I'm so excited about today's episode because this is today episode is for the big players into investment world. It's something that is different from what we discussed until now, and I think it will make a difference to understand a little bit more. Once you become that successful company, what do you do next, and how you can increase, how you can reward after that yourself for your efforts as well.
Yes, definitely. And I think this, if anything, as you said quite well, I think it's a bit outstanding, this topic in comparison to others, because I feel like a lot of our earlier webinars were aimed at the sort of a self-starters like ourselves, like me and my friends and people alike. Whereas this one, apart from, of course, explaining the idea behind it and maybe touching a little bit on the crowdfunding part, which is a bit more for kids, as you once said, kids play, we will dive into something that is a bit more for the serious business and alike. And it takes some time to get there. I don't expect any of us within the next year be venturing into a capital venture of any sort. I feel like this is a really useful introduction to something that may be, I guess, a way of making their life in the long run, especially if they have their own business and they want to take it public. But we'll dive into that a bit deeper in a second. I would expect one to join us today. I believe Hannah and Michael will join. So let's give them a second. I'll ask them.
Do not worry. They can take their time. It's okay. It's a relaxing time.
Okay.
It's a relaxing time. Everyone now maybe they finish their job and they enjoy the evening. So this is today is for education, and it's about how you can grow at a different level, and what it means to actually being a publicly listed company, and how you can arrive to that step. It's a long journey, and it takes sometimes, and for some companies it takes less time. For some companies it takes more time. Everything is based on your experience as a leader of that company, as a founder, and how you can surround yourself with the right people to succeed.
Okay, yes, and I guess maybe before we start as well, Could you maybe elaborate a little bit on your experience on this end? I actually don't know it myself either. Have you had an experience of either taking the company public or seeing someone else do it in front of you? How is that for you?
Well, I did not have the experience to take it myself, the company public, but I have close friends that they did this, and I saw how they do it, how they did it, and because I'm also into the investment world, I help private companies to raise funds from high network individuals. I saw what is the next step after you go through high network individuals to venture capital to private equity. What is the next step? The next step is going public, but it's very important, like a marriage, with what kind of investment bank you go public, and it's important to choose wisely. And because otherwise you might not have success once you decide to launch your company public. So it's very important, the prestige of the investment bank that you work with. Just to make it more clearer, an investment bank, it's an asset management company that is having customers, investors that are pulling money together in that fund, and they decide to invest in companies and help them to go public. So it's very important to choose the right investment bank, which becomes an underwriter, and it will help you to have a successful IPO, which means initial public offering. So I think it's important, this kind of partnership, and what kind of partnership do you decide? And it's important to evaluate very well your options, and as well to prepare your business from the day one. Since you start your business, you need to think like a big business if you want to become a publicly listed company, because many times, like the founders, they try to spend their money on the private things like private jets or anything else. Your business is not yourself. Your business is your business, and you have to treat your business respectfully, because one day you'll get the investors, and one day you'll get the scrutiny of auditors, and they will dig into all the details of your business. Because you'll be becoming a publicly listed company, you have to have your accounts in order, and you need to do this from day one if your goal is to become a publicly listed company.
From the moment you register a business, that's the day one, and
Yes.
From then onwards, make sure that you keep it clear.
Yes,
okay.
and you run your business like a publicly traded company, and you make sure that all your accounts are in order, because otherwise, if you want to sell your business, for example, because maybe you want to exit from your business and you want to exit to a private equity company, in this case, you'll not have problems if all your accounting is in order. Otherwise, you'll have issues, and you might not get anything from all your efforts.
I see. That's really interesting. I think we can start, and maybe they join us if they do. I wanted to start first, before we explore a little bit deeper the IPO and venture capital and the different stages of investment raising, which is very interesting. We've had oh yes,
hello Mikhail, welcome. Nice to see you today.
Yeah, nice to see you too. I'm not alone. I'm with Hania.
Yeah, all family there. Hey.
Hello.
Nice to see everyone. Hello. Hi. Okay.
Hello, guys.
Welcome.
Nice to see you. Thank you for coming. It's a pleasure. Wonderful. Okay. Yes. So before we start, then may we remind our guests, I guess, what we're talking about today. This is going to be a bit different for you guys, so I hope that this is something interesting for the future. We're going to be talking about the different options of fundraising, and we're going to touch slightly upon the fundraising that every one of us could do just simply by going online and creating a page to start picking up money, either for charity or for the next bike or for your business idea. But we will also dive a bit deeper into the higher levels of fundraising, from crowdfunding as the child's play to venture capital and the investment banking later on. So I hope that this is something that might inspire you in the future. Maybe some of you will end up participating in a company that goes public for initial public offering. And if that happens, you will understand what is going on and maybe how you can take advantage of it. And I feel like this is going to be probably the main action point of our webinar. What is initial public offering and why should we care as the public whether or not it's something important? So thank you for joining us. If you'd like to, Hania, turn off your camera for now. We'll go through the adventures of our venture today, and then we'll take it forward. Please feel free to check in any questions in the chat or write them down, and we'll take it forth in a moment. So yeah, without further ado then, I guess, Florian, the best way to start, to kick it off, is to maybe explain what is crowdfunding. It sounds like an obvious answer, but could you just briefly explain to us why should we care about funding by a crowd at all?
Well, let's start with dividing first the first two, the words crowdfunding. So basically it's funding through the crowd. And you have different options. Nowadays, you have an option like going on blockchain and maybe do fundraising by issuing a token. And then this token, you offer some services, anything that your services is doing, and you can raise money like that by offering your services in exchange of the tokens that you can issue on the blockchain. And these days, it's very easy to make such token and listed publicly in a decentralized exchange. Like an example, this is one of the ways that you can do crowdfunding, basically to determine to make the crowd to fund your services. And in this case, you can grow your company. This is one of the way, and it's quite growing at the moment. And another way is basically going on a classical crowdfunding website and sell your services even before you have your services, basically, either services or products. For example, you make an umbrella, a different umbrella, and then you pre-sale all your 5,000 umbrella that you can create. And then this is how this is another method of crowdfunding, by selling your products. Another method of crowdfunding, this is by issuing shares to to high network individuals. And this is another way of doing crowdfunding, basically. But nowadays you also have different platforms that are licensed to offer this kind of opportunities to the public. There are some crowdfunding platforms. Here is very important to bear in mind the risks that you have as an investor if you want to decide to invest in such a company that is at the beginning. Basically, the risks are very high. You may lose all your investment because the company, if it's wind up, in this case, you lose everything. It's important to make sure that you understand the risk. You could also have like to wait a lot of time to make sure that you see a return on your investment. This is another risk that you need to take care if you decide to invest in a company that is on a crowdfunding platform. It's important to understand that if you are a long, patient investor, it's definitely worth your time to look into it, but always do your homework. Basically, make sure that you don't depend on that money that you invest in, and make sure that you are either a high network individual or a self-certified investor, to make sure that you understand what are the risks, because many times people just invest like that without understanding the risks that you expect. So it's important to have this like a part of a diversified portfolio, not to have everything in this here. And it's important to understand how you can do it. You either sell services, or you either propose equity to high network individuals or self-certified investors, but they need to sign a declaration as well that they understand the risk. If they invest in your company, what are the risks, especially at the beginning. This will be the first form. Basically, this is a kids play game of funding. And then you have other steps that we'll discuss later on.
Of course, yes, thank you. So the way that I understand it is all of them are actually as money is, based on trust. It's like promising something in the future. Sometimes that is not even actually even not yet even in the making. So for example, the umbrellas, you can start your business of umbrella making by first getting the money for those umbrellas to be made. So you're selling the idea of the umbrella before it happens. And it was really interesting that what you said about the blockchain. I think that's a bigger topic to maybe dive into later on. But the way that I understand is that you're giving a voucher of trust, yet again, some sort of promise of a usability into the future in exchange for this valuable asset, let's say, or the starting funding amount that is needed. And I think it's really interesting and important here also to mention, guys, this is by now we're on our ninth webinar, and this is even though it might seem like child's play, like Florence said, when it comes to crowdfunding, this is the high risk area. We're not talking here about a stable value holding or stable growth machine. You can earn quite a bit if you invest in something that suddenly shoots up like Exploding Kittens game and becomes an overnight viral, all kinds. But you can also lose it all, because this is the early adoption, and oftentimes those ideas are picked up only by a few people. And if there is no tipping point, people didn't get it all, suddenly it becomes something that 1 in 1,000 plays. So I think this is a good moment, as Florian said, to maybe introduce, and I remember it might have been one of your webinars actually that I've attended. I remember a proper explanation of the steps that are being taken. Let's imagine that we're starting a business right now, and my first idea is taken to my family, and we all decided to chip in £100 and set up my website and take it from there. So what are the different stages, apart from, of course, grabbing your brother's wallet and paying for the fees? What are the different stages of the investment raising that we can go through as a startup?
Well, first of all, you need to think about that you shouldn't start from your family. You should test your idea. You should test your idea on someone that is actually able to pay for the service or the product that you are think of. So basically, you should be in an incubator, in an accelerator or something. You should test your products with real customers that if they would like to pay for the service. Because if you offer a service or a product free, they don't see the value. But if they pay, if the customers are paying for that service or product, in this case, it means that you have a viable product or service. So this will be the first step, to test, to make sure that the product or the service, it can go from. And usually investors, they don't come at the idea phase. Investors, like outside investors, they come once you have a viable product or service that is able to go on the market. Basically, you need to create the prototype already, the minimum viable product at least. This will be the most of the time when the investor come in, when you already have the minimum viable product. For this to happen, you should access some grants, some funds that are available to any startup. And also from day one, you should keep track of your expenses, how much you spend on research and development, because, for example, this kind of expenses can be given back by the government. So you can recover the cost of the expenses on research and development. But it's important to learn from day one how to do it properly. So once you'll be ready, you'll receive back these expenses. And then you need to prove to the investors that you have experience to manage the budget that you have, like wisely. Because usually investors, they want to see this kind of attitude and this kind of experience, either in yourself as a founder, or either in your part-time chief financial officer, that they have the experience to manage a budget. Because if you don't have the experience, you'll just have a burning rate so high that it will not be convenient for the investors to keep sponsoring your company without seeing some results. And usually the investors / sponsors at the beginning, because they don't see a return on their investment, they need to be like angels, that they actually understand the area where you are in. Maybe they already have an exit, and they would like to help other people in the same area. In this case, this will be the ideal type of an investor, of someone that is in a different field. You should look for that kind of individual that have the experience to and to understand you, and have the patience to be patient with you, but also that have the will, the power to guide you on the right track. So I think this is very important. This will be the angel stage. And the angel stage usually is exiting once you arrive to the private equity stage. So basically, either or maybe the angel can exit from your business as an investor on the venture capital stage, or maybe when you are at the stage of raising private equity, at the private equity stage, before the IPO, before the initial public offering. So, and to all you as a founder, you need to construct such a pitch of your business to attract investors that you give them an option to exit if they want to exit from your business. So it's very important to think about all the strategies from the beginning, and also the exit strategy for yourself as a founder of the business. How do you see yourself? Are you seeing yourself to run this business on a 30 years period, or are you seeing yourself to exit from the business on after 2 or 3 years after the IPO? So it's important to decide for yourself what kind of founder I am.
Okay, so quite a few different keywords there, so I'm just going to repeat them for you guys. I think it's quite interesting. If you're a sports fan, you may have picked up the MVP, which is minimum viable product. I think that's actually quite a powerful little thing to have in mind, even if you just want to start a little business of selling, I don't know, a painted cups for coffee. Minimum viable product is, as it sounds, the minimum you can offer that is the product that would somewhat resemble what you have in mind, something that you can actually sell, a product or a service, of course, but the minimum viable product is something that you can already take onto the market and see if it sticks. I guess it's like a real life test for the product. And actually, from what I've gathered from the different books and let's say podcasts that I've had a chance to explore, it actually pays off to try out early and to experiment as early as possible to make progress quicker, instead of waiting for that perfect moment and perfect product, which might be just in your head because you don't know whether the public actually wants it. You should take your minimum viable product at least to the wider group of, let's say, 1,000 people, or, you know, ideally something more, and see if it's something that they can resonate with. And so this is an important little MVP for you. I think also it's important to mention the exit strategy. I think we've mentioned it earlier in the webinars, but it's worth understanding. Exit strategy is basically what Florence said. At which point do you want to leave the business, if you want to leave it at any point? And what is your exit strategy? How are you going to get there? I guess this is a very powerful statement, like start with the end in mind, because otherwise you might just be running on the wheel without an end. And if you don't know where you're heading nowhere. So it's like a never-ending story of, oh, maybe there, but you never know whether you've arrived.
And just to complete what you just said, before I forget, it will be also, if you don't know what is your exit strategy, how you can attract the right investors, because the right investor is the right investor at a certain point of time. It's not like a forever living happily until the end of life. So it's important to make sure that you give an exit strategy for the investors. That's why it's important to know for yourself, firstly, as a founder, when will be my exit? And you may continue, sorry.
No, of course. I think this is really powerful. You know, I remember when I applied for a startup business idea, for which the gentleman Karl that got us to meet one another, actually he won that competition, and the big part of the application was showing to the judges, how are you planning to make this business viable over long term? They were not interested in the next 2 months. They were barely interested whether or not you're going to make money in the next year. They were interested what's going to happen in 10 years from now. So there was a lot of questions of what is your forecast for the next 3 years, and then what is your forecast after you've reached those 3 years, for the the next 7, 8, 9, whatever. So people want and investors want to know where you're heading, because if they're jumping on the wagon, they better know at which point to get out. So
perfect.
Florian,
Before don't forget what you wanted to ask me. Before doing this, I would like to recommend here a book which I think is important at this stage. Is named Traction. You remember we spoke about this, I think, a few Traction by Gino Wickman. I think I'll send you the details as well. And this book Traction is important to understand how you can structure your business to make sure that you arrive where you want to arrive. Because if you don't structure the business is all about people. It's all about company culture. It's all about how do you find the right people in the right seats. Because sometimes if you associate yourself with your friends and family, maybe they are not capable of running the business, and it's your family, are your friends, but it's not, here is about business, it's not about a human relationship. So it's important to make sure that if you want something successful, you need to associate yourself with different people than yourself, not people like you. So people that are different and they can bring value to your company.
Yeah, this is really interesting, that the psychology behind teams and how it actually pays off to have the person that thinks completely the opposite whenever you feel excited, because they might actually hold your horses before you made the blunder. So that's definitely a powerful little. I'll make sure to add the Traction into our readers list for our listeners. So just before we continue, I'm gonna try to represent for our listeners the step ladder, let's say, the steps of different investment parts. And after I do that, if you could just confirm whether or not this is the right way, so we give them a little outline of this. I might even share a little image with our post later on, or a link to it, so people can understand it visually as well, because some people like to see graphs. So the way I understand, the moment you have the idea and you start getting the money in, and you have the pre-seed, which is the stage at which this might be just friends, family, the few people that believe that there is any idea whatsoever for your business. Then you have the seed stage, which might be a slightly bigger, and this is usually to start, to actually take it on and maybe create the first line of your product or the first service. And then we go into Series A and Series B funding. At that point, your business might sell some shares to either the early, as you said, incubators or small investors that would like to participate in the growth, but this is very risky. This is still at the part that your business is quite early on, let's say.
And before you go further, I would like to add here also, this is a stage where you actually decide what kind of investor I need right now. It's not about accepting anyone with any type of money. It's about the investors that can actually add value to your business. It's about that kind of angel that is already having the experience, that is able to give you contacts. An angel usually is not looking to do babysitting with founders. An angel is looking for mature founders that they know what they want, and they need just contacts. They need networks to distribute the product or the service.
Okay, I see, and I guess that's the point that you're already advised by, as you said, the sort of the person, the angel that have been where you are and where you're going, or maybe have been where you're going in a different space of business, and they can sort of guide you in a certain direction. And then we have the venture capital, which we're going to explore in a second to understand what venture capital means, and IPO, which is the big word of our webinar today. And I guess let's start with
and sorry for and before that, before the IPO, and in between, so after the venture capital and before the IPO, you also have the private equity companies, which are the private investment banks. So this is a stage where you actually need to look very carefully what kind of private investment banks I'm looking for to be able to help me to go public, because it's important to have the right partners to be able to help your company going publicly successfully.
Okay, so before we go public, could you explain to us briefly what is venture capital and maybe why is it called venture capital? That's a fun fact.
Okay, so venture capital basically is two words: venture and capital. More people, more angels together, more business angels join together to create a venture capital group to invest in different businesses, and they have a different kind of interest or a sector where they are interested to invest in. If your company matches that sector and you have the right team and the right pitch, and you have a simple to understand product or service that can actually scale, because the main problem with any founder that is looking to raise funds is the fact that maybe he or she did not look properly at the scalability of the business. If you have a coaching business, it's very hard to scale that business. So it's important to either have a service, a software as a service product or service, basically SaaS company, or you can also have a product company, which means that it's easy, you can make it, you can outsource it, manufacturing, and it's scalable. So it's important to understand that usually venture capital, they are looking for scalable products or services. With the products, it's easier to sell because you can outsource and you can make it in a different country to lower down the cost of labor. With the service, also the same, but it's important to understand, to know more about the market of software as a service, to understand how it works and what kind of team you need to be able to be successful, because it's important to make sure that you have the right culture and the right team to show to the investors that you can actually execute the business plan.
Okay, and when it comes to the venture capital, then is nothing more than just a group of angels, or maybe a big group of angels that are particularly interested in a certain niche. And then we come to our big word of the episode, the IPO, initial public offering, everyone. And maybe first, before we dive into why should we care about that and why it's such a big thing when the company goes public, could you just briefly explain what does it mean, IPO, initial public offering?
Okay, initial public offering means exactly as this right on the tin, on the can. Initial public offering is the first time when your company is launched publicly. So the private investor, maybe a little bit less educated, that is not so much informed, they jump to buy the shares. So I make this remark because it's important to educate yourself, even if you are a small investor, to not make the jump in a public when the company is launched publicly. If I'm thinking from the other side, because the price is still not stable. So at this stage, I think if you are a founder and if you need to succeed at this stage, you need to associate yourself with the right investment bank that will be able to join the company as an investor. So you remember we spoke earlier about what is the stage between venture capital and IPO. This stage is named private equity. So basically, you should have a private equity company that is able to join the board of the company and will have the capital power to launch successfully the company. So it's very important to look wisely for this company. Maybe you heard about BlackRock, you heard about other big investment banks. So it's important to associate your name with this kind of private investment banks, because a private investment bank, if they have a better name, is better for your company when you launch it publicly.
Okay, it gives a bit more stability to and sort of promise of comfort to those that want to come forth and invest. But something that I think I conceptually grasp, but I'm not sure if I understand it, so I don't want to say it just yet. Why is it not the right moment to invest the moment it goes public for the first time?
Because the price is going up and down, the price is hype, the hype word. Everything is in a hype mode. So whenever some, the fear and greed index that we spoke earlier in previous episodes that we spoke, fear and greed index are very important even at this stage. When you have a lot of greed in the market because you have an IPO, it means that the price of that IPO can increase, of the shares can increase, but illogically, because the company is not so valuable in order to justify the price of the shares. So I think when it's happening like that, basically it is better to be cautious, to take care of it, and maybe wait for a week or two and then invest in a newly listed company, because then the price settle, and whoever had to exit from the company, maybe some shares of the founders, they want to sell. Because when you are a founder and when you go with your company public, you cannot sell in that stage more than 20% shares of the company. So any initial public offering, you cannot offer 100% shares. You can offer a maximum 20% share of your company to be listed publicly. So, and in this case, usually this is a stage when maybe the angels that invested in your company are getting out of the business and they sell to the public to see a return on their investment. Maybe the venture capital group that invested on the second stage, maybe the private equities that helped you to put their name to help your company launch publicly, they want to sell and then capitalize on the efforts that they did for your company to launch it publicly. You have to think about firstly of your investors, you as a founder, and then later on, after the 2 years period, you can start, you are legally allowed to sell shares if you are the founder of that company. So it's important to make sure that you understand the process and make everyone happy, and then later on you make yourself happy, because maybe you want to sell some shares and have some cash from from selling your shares in the company. Or you can hold it, and if you strongly believe in your company that can grow even further, you can hold and then increase maybe the number of shares. It will have also a dilution. By the way, dilution is very important factor, because you dilute yourself whenever the company issue new shares. You dilute yourself, the existing investors dilute themselves. So is also the dilution factor risk is also present, so need to take into consideration. But it's better to have less shares of a bigger pie than more shares of a smaller pie, because you have we speak about different values.
Okay, I see. Less shares of a bigger pie, better than more shares of a small pie. I guess the security comes here from stability, isn't it? That in a bigger pie, that means that you're already on a bigger scale. You're a stronger company as it stands than if you have 20 shares and it's only me and my family.
Yeah, and here we need to think about like what are the reasons why a company goes public. So these are the main two reasons why a company goes public generally, because the company wants to raise capital, and because the company wants to increase the company liquidity. So we have two reasons: to raise capital and increase liquidity. By having more investors, by having more shareholders, you increase the liquidity, and it's easier to sell the shares and to exchange the shares for the cash, because cash is king. Don't forget this. You can have paper money or can have cash money, so it's important to. But after that, what do you do with that cash? It matters.
Okay. Yes, and I guess before we go any further, I just wanted to remind people here. I think it's a really nice what you said about the hype mode, and now it sort of brings me back to, it's like. It's basically the emotional part. It's like at the very beginning, if you are the first person ever to purchase the initial public offering, you might actually get a good price, but it's very unlikely that you will be the first one. And then this goes up very quickly because everyone is like, oh my God, this is the best moment to buy. That emotion inflates the price, but that price needs to come down as people realize that, well, it's it's not as much valued as we thought it is. It's like the actual market will decide how much this share is worth. And as people realize this is an inflated price, they start selling. And if you've entered halfway through, you've just entered on the peak and you ended up with a loss. And it's much more difficult to get that loss back because it might have been quite a dramatic one, you know, especially as we were talking. I guess at any beginning of investment, at any beginning of anything, the risk is the highest because there is a lot of uncertainty and there is no track record of what happened before. So that's really interesting. A week or two, we should wait at least before we make the decision. Let our emotions come down and see if it's still something we want to invest in. That's really cool. And dilution, I guess the best way to portray it for anyone out there that's still, you know, maybe the word is not familiar. And it's like when you make a tea. When you make the tea for the first time, it's going to be quite strong. When you use the same bag of tea and make 2 teas, and then so on and so forth, and at some point you're just drinking hot water. So yeah, that's very wonderful. So right now, Florin, before we dive into the questions, I wanted to ask you, like, how can we learn, apart from, of course, reading up some books about initial public offerings, how can we learn actually in practice, or maybe by observing someone else? What would you advise us to do if this is something that we're interested in the long run?
Okay, the first 2 questions are, what do you want to be, an investor or a founder? Because it's important to understand from, I can answer to your question in 2 different ways. If you are an investor, I can answer to in a different way. If you are a founder, I can answer to you in a different way. So please choose.
Okay, let's go with our webinar strategy. So we're the investor. At this point, we've made great progress on our savings. We have plenty of investments here and there. Now we want to go into the investing in startups and businesses. How should I go about it?
Well, first of all, you need to make sure that if the business has the right kind of team structure. If you are at the beginning, you need to understand that you might need to help a little bit more the startup to succeed if you are in the investor, and it means that you need to have the time and the experience to help that startup. Otherwise, it does not make sense to invest in a business if you cannot actually bring value to that business as an angel, because in this case, is no point. You need the experience to become an investor in that business. Otherwise, you are like one blind and one without legs trying to run a business. So it's like, you know, so it's important to make sure that whatever you invest in, you have the experience and maybe add some value to that business to help that business to grow. This will be like the angel stage. If you are in a venture capital group, it means that you have a group of people similar to you that join together as a group, as a venture capital company, and they decide to invest in a certain sector. In this case, if you are at that stage of an investor, in this case, you need to identify the right teams, at least minimum 10 to 20 or 50 people, companies where they can actually prove that they can create value in the market and they have a good track record of revenue. And in this case, you can invest in that business. Also, you need to see the company culture, the founders' culture, their experience. Did they wind up previously other companies, because they might just close down the company and then they run with your money. So it's important to look at also this aspect, what kind of credibility and trust you have in that founder and that team, that they will actually deliver what they say that they will deliver. Because usually the companies that wants to raise money is because they want to increase the customer base, and you need money to you need investment to increase the customer base, to do more advertising, to hire more new team members that will be able to generate more revenue, maybe a sales team. So it's important, what do you do with the money? And maybe with the same money that you are looking to fundraise, you want to do infrastructure or research. In this case, what is the risk of the research? So, for example, if you have a lot of competition in a certain field, it means that you have to spend more money to become relevant in the market. So it's important how competitive is the industry you are in, and how much money do you need to burn to be successful.
Okay, yeah, and that's quite an interesting little thing, I guess, for anyone interested in starting their own business or in investing in a new niche. To find the niche, you first need to locate what's missing. That's what you're looking for. You're not looking for what's out there in the market already. You're looking for what's missing between those things and trying to create your own niche. That's really exciting. So in terms of the investment as coming back to our overarching story, let's say, of investment as a way of saving money, putting money to work, making money for the future. What would you say, at which stage should we start caring about the initial public offerings and any sort of startups, especially investments? What is the right moment for us to explore that? Because we've started from nothing. At the beginning of our journey with the webinars, we were talking about pocket money. Now we're talking about angel investors. How did we get here? At which point would you say, okay, you might as well explore this idea for yourself?
Well, I think you should start exploring this when you become a self-certified investor and an educated investor. When you start understanding the risk of investment into the startups and into companies that are not publicly listed, because companies that are not publicly listed, they don't have like clear accounts. That's why I said, if you want to become a publicly listed company, make sure that you run your company as a publicly listed company, even if you are a private company, to make it easier for the listing process. It's important to think about what kind of company I would like to be. I would like to be all my life a private company, and in this case, you have less headache, but also you have less opportunities for investors because you have access only to private, to high network individuals and private and self-certified investors. Or do I want to go to the public? And in this case, you need to have the accounts evaluated every 3 months. And some countries, every 6 months, you have to put the accounts to show the balance sheet and the profit and loss account to show this, to show to investors how the company is performing, because this is a legal requirement to inform investors how the company is performing. So you need to decide, do you as a founder, what do you want to do? And as an investor, if you arrive at that angel stage or venture capital stage, you need to make sure that you actually understand the risk, you know the team very well, you know their capabilities, you know that you can trust them, because it's a very high risk to invest in companies and you don't know the founders and you don't know if they actually can deliver. Because even if they know, they say that they will deliver, they might not deliver, and they might just burn the money that you invest in, and you don't see even your money back. I don't say about a profit on your or return on your investment, but at least the money that you invested in. So you might lose everything. I think it's important to educate yourself, and before arriving to this stage, educate it, and then maybe go with the things that you know. For example, like with the assets that you know, with hard assets, with publicly listed companies that you know about them, and as well with gold, silver, crypto, anything else that is able to perform, and maybe learn about staking capabilities. Because definitely you might have a better return on your investment instead of just saving in the bank. So what I would like to say is that if you want to become a successful person, if you think about saving, you are lost, because saving is just to save your money, but does not save you from inflation, because the government printing more money is devaluating your currency, which means that if the inflation is 10%, you already lost 10% of the buying power of your money. So if the bank is giving you 0.5% interest per year, but the inflation rate is 10%, you actually lost 9.5% of the value of your money. So instead, it wasn't a wise decision to save the money. It's important to learn how to put the money to work.
Yes, amen. And that's I guess why we're here. I'm very excited for our final session next week, which is gonna tie it all together and hopefully bring some more actionable steps for our listeners. So at this point, I feel, guys, it's completely fine to turn on your camera and maybe share with us a few ideas, votes of confidence or non-confidence, questions for anything. There are 5 of you in the room, from what I remember, or 4.
No, 4 of us and 2 dogs.
And 2 dogs, okay, dogs definitely count. Hello. So we might as well ask you if there's anything in particular you'd like to explore a little bit further.
Well, one of the questions that we were discussing here was about dilution, the share dilution. So it wasn't that clear to us what exactly is happening and what exactly. So whether you mentioned the example with a T, okay, but how does that work with shares? And also, we assume that the companies like issue more shares, and we were wondering, when does that happen typically? Why would a company want to issue more shares and dilute the current shares that are on the market?
Well, a company
Right.
would like to issue more shares because maybe they want to make acquisitions to buy another company, or maybe because they want to make some investment in research and development to create a new product or to create a new service. And in this case, you need some capital to do this. You have two ways to raise capital. You either raise capital by going to the bank and take a loan, which means a debt facility. And in this case, you are more, you as a company, you are more exposed to have more financial risk, because when you take a debt, the first thing that you have to pay is to pay the debt back. If the company wind up, if the company fail, none of the investors in the company, the shareholders, they take the money until the bank takes the money, or the company that gives the loan takes the money. So you are the last, as an investor, you are the last paid, and they would like to issue more shares in order to raise capital, because this capital, whenever you issue shares, you don't have to give the money back. So you issue the shares, you give dividends, but only if you want to give dividends. So basically, the CEOs of the company, if they want, they can give dividends, but they are not forced by law to give dividends to any shareholder. And it's important, and that's why this is a risk of dilution, because you'll have the same number of shares, but the value will be less, and because you dilute more shares, because maybe the company is not performing well, and in this case they need some capital to pay the debt that they have. And it's important to make sure that whenever you decide to invest in a company, that you don't know the CEO, or you don't know the team that is managing the company, it's better to do your homework before you start investing, because you need to look into who is running the company, what the previous CEOs have done for the company, and how the forecast is looking.
Does that answer your question, guys? I guess the dilution, the way that I understand it, is like if you have a cake and you cut it in half, and then you're not actually adding more cake, you just start cutting more and more. So the pieces are still of one whole, but yeah, they just become smaller and smaller. And
just give you, yeah, and sorry for interrupting, to give you like an example. So for example, if you have, for example, 100 shares, and you own 10 shares, which means that you own 10%. If the company issue another 100 shares, your 10 shares will be the value of 5%, because you have more, still have the number is the same, but the percentage is decreasing. Mm-hmm. And because the percentage is decreasing, you have less relevance in the company structure as a shareholder. So and they can issue this at any point. That's why it's a benefit, but it's a long-term game to have shares in the company. If you are looking to become like a more short-term or a medium-term kind of investor, it's better to look into debt facilities, loan notes, and that have a fixed period, maybe 1 year or 2 years or 3 years, that they can give you between 7.5 to 10.5% per year. But nowadays, because the inflation is at 10%, it's still not convenient, but at least is an inflation hedge, because if they give you like 10% and the inflation is 10%, basically you didn't make any money, you didn't lose any money, you still keep the value of your money, but it's even better than keeping the money in the bank and they give you just 0.5%. And basically it's important to understand this kind of opportunities as a small investor. What can you do? And usually as a loan note, the loan note start from £5,000 to 25, sometimes to 100,000 pounds, basically, like an example. So this will be, the minimum will be 5K normally, what I saw in the market until now. So but this will be like between 7.5 to 10.5 approximately per year. That is giving you like an interest on your money that you invest in. It's important to understand what will be the facts? This will be like short-term, medium-term kind of investments. But for the long term, are the shares and the equity. But this will be to wait for a period between 5 to 10 years. So whenever you you need to think like a medium to long-term kind of strategy. Whenever you start investing in shares, maybe in a company that it's at the beginning, and you think that that company will succeed. But it's important to do your homework and make sure that the team that is running that company, actually they know what they are doing, and they have a good chief financial officer that is able to understand where to grow. And if they want to grow by acquiring other companies, this is a very good opportunity. It means that they will grow exponentially. It means that they will grow faster than normal, because if you grow customer by customer, it takes a long period of time. Instead, if you grow the company by acquiring a different company in the same sector, you as the holding company that is starting making the acquisitions, it will grow. In this case, it makes sense. Even if you dilute yourself, it makes sense. But you know that the money that the company is raising is not for covering the debt, is for making acquisitions. So if a company is raising the money to make acquisitions, it makes sense to dilute yourself and to be patient. But if the company is using the money to pay the debt, in this case, it's not a very good sign.
Can I ask you one question, Florin? You have been mentioning throughout the webinar a lot, do your homework and do your homework and do your homework. And I haven't been part of previous webinars, so I was wondering, can you give me a short answer on how would I do my homework without having to spend like 3 weeks on studying financial statements of a company and cash flows and different other kinds of papers? How would I do, how can I efficiently do my homework on a company?
Okay, if you don't do this, someone else will do it for you and you'll lose money.
Okay, so I have to spend the time.
You have to spend the time if you don't want to pay someone else to do their homework instead of your place. You know, because what the pension funds and the hedge funds are doing for other people, they do their homework, but they take an interest on the homework that they do for other people, which means that sometimes it's quite expensive, because usually the biggest players in the market, if they give you any investment advice, they take a percentage out of your investment portfolio. But sometimes the people that are running those businesses are youngsters, that they take more risks, they don't have a balanced strategy, and in this case you expose yourself to someone that they don't actually know what they are doing. That's why it's important, you as an investor, whenever it's your money, it's your interest, so it's important to do your homework again, because otherwise you don't understand. Even if you lose something, you understand why. But if you lose it and you don't understand why, in this case it's a very bad situation, because it's important to try and test and see what works for you and what kind of person I am. And firstly, decide for yourself what kind of investor I am. I'm a short term, I'm a long term. Do I like risk? I don't like risk? I'm a fear, I feel the fear, I am greedy person. Always work on yourself as a personality, because if you do not know yourself, you make mistakes.
Mm-hmm.
And
yeah, sorry.
Yeah, no, go on.
Okay, one more continuation on this. So if I don't have the time to do the homework, should I like skip considering investing, or should I go to something like index funds or like something way more safer? Well,
nothing is safer these days because of the inflation rate. Remember, inflation rate is 10% in UK, for example. In other countries, 14, 15% is quite high. So now is the time to do the homework, because otherwise you might lose even more than what you save it. So, and whenever you think about saving, it will be a safe haven. It's not safe at all, because it's a fiat money that the government is printing. And as soon as they print more money, it means that they dilute the value, the buying power. So it's basically the fiat money is like are like shares. Yeah, you print more, you dilute the value.
Mm-hmm. Okay, so do my homework.
I have an answer for you. I mean, this is just the start of the conversation, really. But you know, first of all, we've, as you mentioned, we've been doing this for 9 weeks now. So there are the videos which are. It's not going to take you 3 weeks for sure, but it's. I think it's a good introduction to the whole idea, maybe to some ideas. And what I found, because right now it's interesting, because you joined us at the stage that we're talking about the big boy game, which for me, for example, is completely out of the picture. I'm interested in it, but it's not really something practical advice for the next week for sure. I've been dabbling with a few different versions of the investments that we've mentioned earlier, and I feel like we can definitely take action. Next week, I will also invite you guys to consider what's to come. I feel like after our webinars, it would be a good idea to start a bi-weekly meetings, just informal. Maybe Florin can visit us from time to time to give us his insight, to actually put this knowledge in place. And you can start investing from as little as £1. So it's not, I don't think you can build Rome in 1 week. It's definitely going to take you some time to understand those things further. But I've been learning this for 2 months and I barely understand half of it, you know. It's a work in progress. And we will also provide in the description of this video and in all others, we will provide you with the books, sources, let's say, that Florin recommends and that I've explored and some of us have been exploring. And I feel like those are a good start as well, because, for instance, for me, the Bitcoin Standard, even though it's a book about Bitcoin, it's the way they explain money and value. It has made all the difference for me. I've read Rich Dad Poor Dad before. I've read the Rich Dad Cash Flow Quadrant. Fair enough, but if you don't know the basics, he's talking to you and like, that's amazing, but you don't actually know what he's talking about. Whereas the Bitcoin Standard has 5 chapters about the value of money. Why is it that Florin keeps saying it again and again, don't save money because you're losing? How does that work? Many people don't understand it. And I feel like I didn't actually grasp it either at the time. So we'll check in some links for you. Hania can add you to our group as well, so feel free to join us for the next time.
And just to complete yourself, just look at the previous podcast episodes that we had, because it will give you, especially you start with the first one and then continue with the crypto podcast episode to understand a little bit more and what can you do to understand where the world is going. Because even in this podcast episode, even if we speak about crowdfunding and private equity and fundraising, I still started with a new method of fundraising, which is going to utility tokens. And it's important to understand how this sector is growing, because it will change so much the industry, and it's important to understand and to educate yourself, and do not leave what you can do for yourself, because it's very important, you as a person, to educate yourself and to not leave someone else to give you advice, because sometimes these advisors are school teachers and they do not know what they are talking about. And in school, they don't teach us about money and about value and about cryptocurrency and about currency and what is fiat money, what is actually real money like gold, silver, and other crypto stuff. It's important to understand what is a market capitalization, these terms, what is a liquidity pool, what means liquidity, because if you have an investment that is not liquid, you are stuck. You remember, everyone is investing in a house. Yeah, a house is a long-term investment, but is illiquid. So it's important as well what kind of investor I am. I'm a risk taker. I'm a long-term, short-term. I want to act fast. I want to wait. And you need to have a little bit of everything, but you need to practice with everything to understand how they work. Until you don't practice it, you'll not understand it fully. If you base your strategies on someone else's advice.
And yeah, before we finish, and I guess we'll leave it for next week to arrange whether or not you guys would like to join. I feel like this is I'm gonna definitely start doing it with Connor, because we've been talking on the phone a lot, and by now I feel like it's about time we take action. Because if you keep talking about stuff but you never take action, well, you just had a nice time with us and you stared at our faces, but that doesn't really get you anywhere, you know. If you would pay, if they would pay you for that, I'm jealous. But yeah, guys, one more question then for you. Do you have any other ideas, questions, thoughts about today? Anything else? Maybe Michael was trying something out the other week and wants to use this moment for advice. Anything at all?
Well, being honest, I haven't tried anything, but in order to maybe put value for extra value for this wonderful meeting, in terms of building the team and the like internal culture and the things you mentioned, I've had an opportunity to read a book called How Google Works. It's a pretty common one, but I'd say that it was it's marked as one of the best in terms of describing how you should build a team, because it basically shows the way Google went through as a company, which is now a role model for all the others. So if you're sharing books, I could recommend that one.
Good point.
And
good point. Very good.
Yeah, it's worth to be read.
And because you also added value, I also don't remember to read the book Traction, because well, you'll find it on Audible to make it easier and save more time, because this will make you to understand what kind of people do I need in my team to grow my company.
Okay. Yeah.
Right.
And if we're talking about the books, could I ask about the one with about the taxes and how tax work? Because I kind of lost it. Have you shared it somewhere?
Yes. So it's you can find I can find it for you right now. Tax.
Maybe, could you just put in the group, like
Yeah. We'll do, of course. Yeah.
About other book as well, and I would use.
I'll put it with the post tomorrow with this one. I'll put it as well, but I'll just send you a message today, Michael. It's fine. It's Tax Health something. Tax Health, Rich Dad's Advisory, something like that. Remember, guys, though, the one thing, it's great, but I feel like the trick with Rich Dad Poor Dad is he refers to the American market. And that is, it's good to understand and then try to figure out your own market. But remember that when you read the advice given there, don't apply it in Denmark without first checking what's happening in Denmark, because it might be completely different. I feel like the theory books, like Bitcoin Standard, Rich Dad Poor Dad, as long as you're not actually following the person signing the contract, you're in the clear. But the moment you're starting to make moves, let's have a discussion or a thought at least about it, because we might break the law, for example. So thank you so much for joining us today. It was very nice to see you, and thank you guys for joining. I hope that the other webinars might pick you up to speed, and feel free to join us next week. And as I said, we might take something forward to take action, because I feel like this is something that has been brewing, but we're wasting time. The moment we're waiting for the next month to start investing, you just missed out on a month. So
thank you as well, Wojtek, for having me. Thank you everyone else for this evening and for your time. I hope we could add value to you as well, and hopefully we'll see. This will be for the future as well, to remember to ourselves how we have been at this moment in time, and what makes us to change our future and our mind, and how we can impact also other people's life, because I hope that by impacting you can impact at your point, in your turn, other people's lives, and add the same kind of value and build a culture, that a community around these subjects.
Yes, and thank you, Florian, for joining. Thank you guys for coming. It's been a pleasure. I took a cheeky pick as we were talking as well, so we have a bit more in action shot. And yeah, join the group. Feel free to reach out on the comments. I'm active there to see and help. Hania can connect you with anything you need. And have a nice night, guys. Thank you for your time.
Good night.
Thank you.
Bye-bye. Good night. Thank you.